Welcome to Fitch Ratings' Fixed Interest podcast. My name is David Prowse. The result of the US election could arguably be the biggest single event that will matter for credit in 2025. Today, I'm joined by Richard Francis, Senior Director in Fitch's Sovereigns Rating Group and the lead analyst for the US Sovereign Rating. I also have with me today Justin Patrie, head of the FitchWire team, who is the lead author of our post-election report covering the key policy implications for credit. Let's start with the US Sovereign Rating. Richard, what does the election result mean for the US sovereign credit profile?
Long before the November elections, we believed that no matter who won, the 2017 Tax Cuts and Jobs Acts, set to expire at the end of 2025, would largely be extended or made permanent. The election of Donald Trump and the fact that the Republicans have won both the House and the Senate make this assumption a near certainty. As a result, we don't see the United States' underlying fiscal stance changing much from our base case. We see the general government deficit, which includes the balances of the federal as well as the state and local governments, reaching 8.1% of GDP this year. For next year, we expect some modest improvement to the fiscal deficit to 7.6% of GDP, mainly due to a rise in revenues propelled by the better than expected economic outturn this year, robust performance of the stock market, and the imposition of expanded tariffs. Given the extension of the 2017 tax cuts, we see little change to the deficit in 2026 from 2025, however. And as a result, the government's debt to GDP will continue to rise from already high levels, reaching 120% of GDP by year end 2025, which is almost 2.5 times the AA median of 48%. We expect the debt ceiling suspension that terminates at the end of the year to be resolved in a less contentious manner than last year, most likely in the appropriations negotiations that we expect to be resolved by April of next year. However, the narrow Republican majority in the House could continue to pose challenges in a variety of budgetary matters.
You say that the base case assumptions have long included an extension of the 2017 tax cuts, but how would new tax cuts beyond this extension impact fiscal dynamics in the US rating?
Our base case currently envisions just the extension of the TCJA tax cuts. Of course, we do recognize that on the campaign trail, Trump pledged a number of additional tax cuts as well, including a further reduction of the corporate tax rate to 15% from 21%, exemptions for income taxes on Social Security, overtime earnings, as well as income from tips. Taken together, these pledges would increase annual deficits by an estimated $400 billion per year or more, and put the already high and rising debt on a significantly sharper upward path. Of course, we do believe that there's some scope to offset additional tax cuts with increased tariffs and spending cuts. However, on the spending cuts, we see a limited room to make significant cuts, given the fact that only 15% of the entire federal budget is discretionary non-defense spending. In fact, the intense debate over the debt ceiling last year only culminated in an agreement that signified very limited expenditure cuts in the end.
Right, and tariffs were a key plank of the Trump platform, and it seems highly likely that an increase in tariffs will be a major priority. Will this have a material impact on US growth to the point that it becomes a credit issue?
So yeah, Trump recently announced that he would impose significant tariff increases on China, Mexico, and Canada, the three largest U.S. trade partners, from day one. My colleagues in the economics department ran different tariff scenarios a few months ago and looked at their impact on growth and inflation. One scenario, which looked at 60% tariff rates on Chinese imports, as well as a blanket 10% across the board use of tariffs, indicated a significant hit to U.S. growth of close to 0.8% of GDP in the first year, but the impact would gradually fade away over the following 4 years. However, in the same scenario where tariffs were introduced and the U.S. trade partners retaliated with tariffs of their own, the impact would be much larger, up to 1.1% in the first year, and it would be more persistent, lasting multiple years. So on inflation, higher tariffs in either case meant an impact of about 0.4 percentage points, but only over the short run. In the medium term, the impact of inflation would in fact be negative, as weaker demand translates to an easing of price pressures, and interest rates would in fact be lower. On the revenue front, tariffs do add additional revenues, but in the worst case scenario that we talked about, The large hit to economic growth prospects for an extended period of time would dampen other revenue sources that would ultimately lead to higher deficits and exacerbate the already adverse debt dynamics, and thereby undermine the U.S. creditworthiness.
Switching now to Justin, looking beyond the sovereign rating, what are the key policy initiatives that Fitch's ratings analysts are most focused on following the election?
Yeah, so in what seems like a lifetime ago, way back in July, we first published our views on the key kind of policy implications and themes of a change election in the U.S. where Trump would win the presidency. And those policy themes still seem to be the most important to watch following the election result. And through that analysis, we highlighted 7 major policy areas that we felt would matter most for global credit across different sectors. And I know I've stated those before in the podcast before, but to repeat, the 7 are trade protectionism, continued fiscal pressures, as Richard mentioned, geopolitics and foreign policy, climate policy rollback, financial deregulation and privatization, social policy reform, especially focusing on healthcare, education, and housing. And the 7th theme was restrictive immigration policies. So those remain the key policies that are going to matter to the largest number of credits going forward.
And has a Republican sweep affected which of these themes matter more or less?
Yeah, I think so. The polls ahead of the election were pretty consistently indicating a 50-50 toss-up for the presidency, a likely Republican victory in the Senate, and another toss-up for the House. So the fact that the Republicans won both houses of Congress and the presidency is meaningful, and certainly at the least is going to facilitate legislative cooperation with the broad Trump agenda. So we can kind of move forward with greater certainty that the Trump platform is going to see some very specific policy and legislative initiative pass. It seems clear that early priorities among those 7 themes are going to be trade protectionism and immigration restrictions. So, as Richard said, there's a high probability of material increases to tariff barriers in the U.S. There's likely to be some level of retaliation from major trading partners. And there's a major focus on immigration enforcement and policy up to and including large-scale deportations. Beyond those immediate core priorities, tax policy, a deregulatory agenda, these are also notable that seem likely to have some sort of policy platform in 2025. Tax cuts provided a notable cash flow boost for U.S. corporates back in the first Trump administration. And if they do go further in 2025, that would provide a notable tailwind for U.S. corporate credit profiles, though at the expense of the fiscal accounts. Deregulation in the financial sector and for energy could also boost profitability for those sectors in the short run.
And what are the winners and losers from the Trump policy platform?
Yeah, the markets have been talking Trump trades for quite a while, and there's no shortage of commentators out there putting together indices of various companies and sectors that they feel will benefit from the Republican policy agenda. From our end, we look at through the cycle fundamental credit profiles and are less interested in short-term equity market moves. With that in mind, some winners would certainly include the U.S. fossil fuel energy sector, which could benefit in the short and medium terms from rollbacks of climate-related regulation, which could have limited growth or required additional capex. Certain strategic U.S. manufacturers will benefit from rising tariff walls. Defense sectors globally have benefited from the geopolitical environment, and the Trump administration's focus on boosting NATO defense spending is likely going to continue that trend. On the negative side, obviously producers with supply chains outside the U.S. will be looking very closely at tariff implications. Blanket tariffs will disproportionately affect major trading partners, including China, Canada, and Mexico, both at the macroeconomic level and certain sectors which have disproportionately intertwined supply chains. We recently saw Trump pledge additional blanket tariffs on China and new tariffs on Mexico and Canada. Beyond the tariff implications, Trump's climate policies, and if they involve major rollbacks to subsidy programs and slow the decarbonization transition, it will raise significant uncertainties for sectors that have made strategic bets on that transition. So that can include transactions and sectors with exposures to renewable infrastructure, utilities, public power, those sorts of things.
Okay, thank you, Justin and Richard, for sharing thoughts on this week's Fixed Interest podcast. And as always, thank you very much to our listeners and subscribers. If you'd like to learn more about Fitch's credit ratings and credit views, please visit our website at fitchratings.com.